Good afternoon, everyone. You're all welcome to another session on strategic financial management. This time, we're taking our class further from local investment appraisal to international investment appraisal. So that will be the focus of this class. And to do that, we would be practicing November 2020 question 1. Okay, so the good thing about strategic financial management is that the topics build on each other. So it has some benefits, and the benefit is that all of what we discussed under local investment appraisal NPV would be applicable for our international investment appraisal. What we will just do would just be to build on that by discussing some additional concept that are applicable whenever you decide to invest overseas. Beside that, the principles around regular taxation payment, principles around capital tax allowable allowance, or what we call capital allowance, really. The principles around real cash flow, money cash flow, and all the other things we discussed would be applicable to our discussion on international investment appraisal. So if you've not, I want to believe that if you missed the class, you would have watched the video because you need that knowledge as we move on into international investment appraisal. We wouldn't be going back to local investment appraisal in this session. However, we'll try and maybe touch on a few things whenever it has to do with the principle related to local investment appraisal, but we won't spend as much time as we did when we discussed local investment appraisal, explaining the concept and terms again. Otherwise, we will not cover much. So I want to encourage everyone, if you've not caught up with the videos in December up to last week, please try and do that, because it's going to bring you up to speed on those principles around investment appraisal. And those principles are applicable not just for local or international, but for anything that has to do with advanced investment appraisal. So be it whether we are doing the normal local investment, we're doing international investment appraisal, we're doing mergers and acquisition, we're doing business valuation, anything that has to do with investment appraisal to a large extent, all of those principles are valid and would always be applied. Okay, so please catch up if you've not done that it will be super helpful for you, so that you can easily follow up and know how the topics build on each other. So with that said, let's get right into our objective for today, which is international investment appraisal. Just a sec, I'll just share my screen and then we can get started on that. Okay, so while we do that, when we say international investment appraisal, I'm trying to get my screen up, just a few terms around that. When we say international investment appraisal, what we're basically saying in very simple and lay terms is a business in one country that chooses to extend its investments into the shores of another country. That's what international investment appraisal is about. Now, if you invest in just your own country, you're exposed to your currency only. So, for example, if a business decides to invest in, say, just the US or just Nigeria, it doesn't import, export, or carry out any other investment in every other country. All of its transactions would be in its own currency. However, when a company decides to say, let's go international, let's explore the concept of investing in another country, it becomes exposed to that currency because it needs to maybe buy raw materials from that country, maybe it needs to sell goods to that country, maybe it needs to move investment funds from its own country to that foreign country. Now, when it does that, it needs to know, and you need to know as well as strategic financial managers, how to convert currency. So one of the things we need to know under this topic, in addition to everything we discussed under NPV, these are concepts that are peculiar to this specific topic. One of the things you would know, and you also need to know as well under international investment appraisal, would be currency conversion. If we need to convert naira to dollar, or dollar to naira, or dollar to the pound, or pounds to the sterling, or pounds to the euro, or maybe you're converting one Ghanaian cedis to naira, how do we do that? How do we accomplish that? And that is the concept of currency conversion. That is something you would need to know. Second concept you would need to know would be the concept of international taxation. Sorry, I'm not sure why my can. Okay, yeah. So that's the concept of international taxation. Okay, so why is this important, and why do we need to know about international taxation? Now, if you invest in just your own home country, you're exposed to a single corporate income tax. Generally, we assume that. But however, if you decide to invest in another country, you're exposed to two things. You're exposed to the tax rates and the tax laws in that country, and you're also exposed to the tax law and the tax concept in your own country. So you need to be able to know and understand how to treat those taxation. And sometimes too, between countries, you have what they call bilateral trade agreements. So you need to be able to identify and treat those appropriately. Third concept, which you need to learn in addition to everything we've learned on local investment appraisal NPV, would be concept of transfer restriction, or restrictions on repatriation. It's a profit restriction that has to do with repatriation of your fund. All right, so that's another concept you need to learn. So sometimes in some countries, when you invest in the country, they might have certain restrictions to say, for example, you can't repatriate your funds maybe until after you've been in the country for, say, 5 years, 3 years, 2 years, 1 year. Or sometimes they might have a restriction that says you can only repatriate 80% of your profit or 50% of your profit. So we need to be able to treat that, to identify and to treat that. So that's a concept that I'll also spend some time explaining when we get to that part of the question. Another concept you need to understand is the concept of transfer pricing as it relates to international business. Just a sec. I'm not sure why my pen is disconnecting. Just a moment. Let me get that reconnected. Okay. So the further concept is the concept of transfer pricing / transactions between the parent company and the subsidiary. Transactions between the parent company. So sometimes you would have the parent company might sell certain parts or certain items to the subsidiary, or the subsidiary might sell certain parts or certain items to the parent company. Or the parent company might offer certain services to the subsidiary and vice versa. So there's some form of transfer pricing involved, some form of transaction between the parent company and the subsidiary. So these are concepts or additional concepts. Okay, so there's one more finally, please. And that is the concept of cost of capital. Or WACC. And the big question under cost of capital or WACC is, should we use the cost of capital in the foreign country or should we use the cost of capital in our own home country? When I say our home country, I mean the parent company that is deciding to invest in a foreign country. So the concept of cost of capital, you're going to be looking at that of the home country versus the subsidiary. So which of them are we using, and under what conditions do we use these the cost that particular cost of capital? So these are the new concepts, guys, that you should learn on international investment appraisal. Like I mentioned much earlier, and let me just repeat that for the purpose of maybe those that just joined. You need your knowledge, the knowledge we covered on NPV for international investment appraisal, because we're going to build on the knowledge. So for example, in our local investment appraisal, which we considered in December and much earlier, concept around how to present your answer, concept around what is a relevant cash flow, concepts around tax allowable depreciation, concepts around how to treat money and nominal cash flow, concepts around project adjusted cost of capital if you are moving into a new line of business in the foreign country. All of those concepts, you need the knowledge. You need the knowledge on international investment appraisal. So just one more time, if you've not watched those videos, please, or if you're not in the class, please try and catch up. Try and catch up ahead of our next class. All right. So these are the new concepts we will learn, which you are required to learn with regards to international investment appraisal. So sometimes you might not have a question that has all of these concepts, but I'm going to try and explain this concept as we go along in our question for today. Okay. So this is what I'm going to do. Let's read the question, and then we would explain the concept as we go along. So once I get into a concept that is new, that is not a concept we discussed under a local investment appraisal NPV, I would explain the concept first before we proceed. So that way we're able to at least make some progress with regards to our question. Okay. So let's do that. Okay. Let's do that. Or maybe we can even explain this concept first. We just take a few minutes and explain the concept, and then we can go to the question. But we're not going to be able to explain everything because we're still going to speak on them when we're in the question. So I'm trying to avoid I'm trying to ensure that we make good use of our time so that we don't explain it now, and then when we're solving it again, we're going back to explain what we explained already. We can save on our time. So let's get right to our question, and then we'll come back to the concept. So when we explain the concept, we're going to have it above the question, and then the solution, we're going to have it below the question so that it flows, so that you don't get them mixed up. So let's get right into it. It's question 1, November 2020. Question reads, assume today. So just before I proceed, just double check it. You guys can see the question in front of you, so I'm not reading what you're not saying. Can you guys see can you confirm you can see the question? Can someone quickly confirm to me? All
Yes,
right,
we can see it,
thanks,
sir.
Yeah, thanks, Yusuf. All right, so let's get right to it. Assume today is November 20th, 2019. In 2018, the Oyin division of Abba PLC successfully launched a new premium wine, Aladun, in Nigeria. The divisional board of Oyin division is now considering plans put forward by the divisional marketing manager to launch the full range of Aladun in another country, Linda. So you can see immediately you're seeing the fact that they are considering investment in another country. That tells you that this is international investment appraisal at play. All right. So Nigeria going to Linda. Linda has Lindarian dollar as currency, and the launch is planned for January 1st, 2020. That's when they want to launch the business. It is well known within the industry that it can be very difficult for a foreign company to break into the Lindarian market for fruit wine because there is a significant loyalty towards local Lindarian brands and imported South African brands. Initial market research based on free testing sessions has met an encouraging response, but there is still some uncertainty about the success of the launch. However, the greatest danger to the success of Aladun in Linda is considered to be the risk that the Nigerian competitor might launch a similar range of products in the same market. Financial data for the project. To date, 5 million has been spent. So that is some cost. We explained that concept when we did NPV, local investment appraisal. That has been spent, it's a sunk cost. To date, 5 million has been spent on initial market research for the Lindarian market. If the project is approved, an additional 20 million will be required for detailed market research and packaging design. The cost of the launch itself includes an expensive radio and television advertising campaign in Linda, and it is expected to cost about 10 million. Both of these costs are tax deductible in Nigeria. In addition, 84 million will be spent on a distribution center in Linda. All of these one-off costs are payable on January 1st, 2020. Estimates of net operating cash flows for the project vary considerably according to assumptions made regarding consumer and competitor reaction to the launch of Aladun in Linda. Forecast cash flows figures for sales revenue and associated costs for the project for the year ending December 31st, 2020 have been identified based on two possible scenarios. Scenario A and Scenario B. The forecasts are operating cash flow figures for the year ending December 31st. So you have your sales given to you as 100 million in Lindarian dollar. We have our cost given to us as 10 million Lindarian dollar plus 20. Sorry, I need to mute whoever is speaking. Okay. So you have a cost given to us as 10 million Lindarian dollar plus 20 million naira. You cannot add You cannot add $10 and 20,000 naira together. You need to convert one to the other to be able to add them. So that basically says, she'll tell us all that when we get to that. So the cost is 10 million Liberian dollar and 20 million naira. So that's for scenario A. And then for scenario B, you have sales revenue, 55 million. And then you have the cost given to us. There's no need to read there's no need to read that. All operating cash flows shown above are expected to grow by 5% per annum in subsequent years for the duration of the project. It can be assumed that if scenario A occurs in 2020, it will also occur in all subsequent years. The same is true for scenario B. It is estimated that there is a 70% probability of occurrence of scenario A and a 30% probability of occurrence of scenario B. Other relevant financial information. OIN evaluates its project, OIN division evaluates project of this nature at a risk-adjusted after-tax discount rate of 15% over a 4-year period. The proposed new distribution center to be built in Linda is expected to have a residual value of 52 million Lindarian dollar after 4 years. Point 3. Corporate income tax is charged in Nigeria at 35% on taxable profit and is paid at the end of the year in which the taxable profit arises. No separate tax is charged in Linda. Tax depreciation allowances are available in Nigeria on all capital expenditure incurred both in Nigeria and Linda at a rate of 100%. Balancing charges will arise on any residual value. There are subsequent profit elsewhere in the group to be able to take advantage of these tax benefits or any taxable losses that occur. Operating cash flows should be assumed to arise at the end of the year to which they relate. That's operating cash flow. The exchange rate is expected to be 1 naira is equals to 1.2 Lindarian dollar on January 1, 2020, and the naira is expected, my screen shift moved a little bit. Okay. And the naira is expected to strengthen against the Lindarian dollar by 3% a year in each of the next 4 years. The project could be abandoned on January 1, 2022, and the distribution center sold for an estimated 70 million Lindarian dollar. If the projects were abandoned on January 1st, 2021, no further cash flows, inflows or outflows will arise from then onward, and there would be no penalties for pulling out of the market. Ignoring the abandonment option. In other words, ignoring this additional information, because this information is what talks about abandonment. So just assume that for this particular question, assume that this last point does not exist. So ignoring that last point. Calculate the NPV for the project as of January 1, 2020 for scenario A and scenario B individually, as well as the overall total expected NPV. We talked about the concept of expected value in one of our sessions, and so I want to believe you know what expected value is. basically multiplying the values by the probability and summing it up. So those concepts come into play as well here. So you need to catch up on all of those videos. All right. 2, calculate the payback period for the project for each of scenario A and scenario B. A3, interpret your results from A1 and A2. B, evaluate whether or not the project should be abandoned on January 1st, 2021 if scenario B occurs. And C, advise how real options and other strategic financial issues might influence the initial investment decision. So that's a question. It's a 3-page question from the original ICAN question paper, really, and that's a question 1, 2020. Okay, so let's take a few minutes to even understand the question. So you'll have a company in Nigeria called Abba PLC. So their Oyin division manufactures a premium wine named or referred to as Aladun. And right now they are saying, can we go and manufacture this same wine in a new country called Linda? And so they will need to invest money in Linda to set up the company, and then they will generate some form. They will generate sales. They will generate sales, and then they will incur some cost as well in Linda as well. So all of that would happen. Would happen in Linda, and then you have the cost given to us in both the other currency and in Naira. So you have a mix of all of that. They give us the exchange rate. They give us what the probability inflation or rate is expected to be over the course of the next couple of years as well. And they're trying to decide on whether or not they should invest in Linda or not. As part of the question, they have an option to abandon, to say, okay, we can start, but after a year or so, what year they're considering abandoning it? Okay, they can abandon on June, that we can start, and then on January 1, 2021, we might decide to abandon or not abandon. So the question is telling us for part A, without considering the possibility of abandoning, can you tell us, as a strategic financial manager, can you look at the data we've put together and tell us or advise us on whether or not we should proceed with the investment? And that's the first part we would do. And the question tells us that there are 2 possible scenarios based on their projection, and we should do the calculation for scenario A as a standalone. We should do the calculation for scenario B as a standalone, and then we should do the overall expected NPV. We know what expected value is because we've discussed that and we've solved the question on that. Expected value is basically just multiplying the values by the probability of occurrence. We've discussed that in one of our previous sessions. Okay, so let's get right into it. So the first question would be, how do we present our answer? We have discussed that when we did NPV. So when we did NPV, we discussed how to present your typical answers in terms of your sales, variable cost, your fixed cost, and all of that. So, but we will discuss that. We're not going to discuss that anymore. We'll just present it based on what we've discussed before now. The only the next point would then be that you have an investment by a Nigerian company in Linda. So what is the best way to approach that the presentation? Now, there are 2 ways. So sometimes you decide, or some presentation formats will decide to present a consolidated position. So what do I mean by consolidated position? They only have one financial statement, but in that financial statement, they add everything that is happening in Nigeria and everything that is happening in Linda into one line. In other words, consolidated statement. But there's a problem with that. It's allowed, but there's a problem with that. It doesn't work in all scenarios. So because it doesn't work in all scenarios, for example, if you have tax in the foreign country, it won't work because you need to compute the tax in the foreign country separately and then move it to your own home country, the balance to your own home country. If you have restrictions in terms of what you can move, you sort of stuck with that presentation format. So I don't like, I think that if one has to learn one method, that is a KG method because it won't work in all scenario. The second method would be which is the very clear and easy part, is to say, can we determine what our performance is in Linda or the foreign country? Can we determine or compute our NPV in the foreign country? And then we move the value into our home country and compute what the final NPV is. Now that method or that approach will work regardless of the data or information you have in the question. So whether you have taxation in both countries or not, whether you have restrictions in any of the country, that format will still work. But the format where you present the consolidation from the very beginning will not work when you have taxation in the foreign country and all of that. So in terms of our presentation format, this is what we're going to do. And this is what I would recommend that you do. And the reason I explain it is because when you have a look at ICAN pack, sometimes ICAN will present the answer using a consolidated method. Sometimes ICAN will present the answer using separating the performance of the foreign country and the performance of the home country. We won't do both. So I'm going to stick with separating the performance so that you can use that method regardless of the question. So our format is the first explanation we're making. So the first thing would be on our format. So the format I'm recommending that we use, which is what we're going to use in this question, is to present the results of the foreign investment and the results in the home country separately. Yes, so what do I mean by that with a quick example? So if, for example, you're a company in Nigeria and you decide to say, let's invest in the US. So we're going to first begin by determining, can we put together what our NPV is in US? And then whatever we've made in US, we can then move it to Nigeria and present what our final consolidated value is in Nigeria. So that's what I mean by that. Rather than just presenting a consolidated value from the very start, because that will not work in our scenario. Okay, so that's our first step. So let's get right into it by applying some of the principles. As we go ahead, we'll come back and explain some additional principles in our question. Okay, so that's our first step. So we have to go into our solution now and begin to do that. A, so OIN PLC, we're doing scenario A first. So we're beginning with scenario A. So OIN PLC, investment appraisal. A, international investment appraisal. So that's our focus right now. So we're going to begin with our scenario A. Okay, so let's begin with our performance in Linda, which is the foreign country. So we begin with our performance in Linda because we want to know how we did in Linda and the currency of Linda. What's that currency? It is Lindarian dollar. It is Lindarian dollar. Okay. Now, if you remember the principle we discussed when we did local investment appraisal, we said one of the first things you would do is to determine what is the tenure of the project or investment, because you want to know how long, how many years you're going to project into. So first question back to our investment, what is the tenure of our investment in the foreign country? So let's quickly pick up that information from our question quickly so that we know the years we're going to write down for our evaluation. Okay, so it's question, the project is for how many years? Right here it tells us 4 years. Here it tells us so 4 years. For let's see. So you can see it tells us it's for 4 years. Our project is for 4 years. Okay, so our project is for 4 years. Yes, our project is for 4 years. So what are the years involved? Today is 2019. We have not started. We plan to launch it. We plan to launch on January 1st, 2020. So that would be our 4 years would be 2020. We plan to launch on January 1st, 2020. So our 4 years would be 2020, 2021, 2022, and 2023. Those are 4 years. However, just like we discussed when we did local investment appraisal, if we have any transaction before that year, maybe we have transaction in 2019, we need to bring that into account. And if we have tax that is payable in advance or a transaction that extends into another year, we extend it by that year. But right now, the project is originally set to last for 4 years. The launch date is January 1st, 2020. So we're going to have our values then. For 2020 first, 2021, 2022, 2023. Let me give some space because if tax is payable 1 year in advance, like we discussed on that NPV, we might add 1 more year. So let me leave it up to this point. So this would be our 4 years based on our projection at the start. Year 1, year 2, year 3, and year 4. Okay. Now the values are given to us in million, 100 million, 52 million. One thing I find is that if you write, when you have a large value like that, you write 52 million, you would struggle with space. And 2, you are more likely to make mistake because you're dealing with how many digits? 1, 2, 3, 4, 5, 6. 1, 2, 3, 4, 5, 6. You're dealing with 8 digits. You're more likely to make mistakes. So oftentimes people just take off some of the zeros. So we can take off 3 zeros or we can take off 6 zeros so that we can manage the value, and it reduces the possibility that we would be prone to error or we would make mistakes. So because they are given to us in maybe 52 million, 100 million, and all of that, we can have our answers written in millions. So I'm going to write it at the top so that my examiner knows that I am presenting my answers in millions. That is an important concept and approach students sometimes miss. So the examiner knows that I'm presenting all the values I have. If I have 10, that is 10 million. If I have 52, that's 52 million. Okay. So now that we're out with, we've completed how our table will look like in terms of the currency. Let's now get right into it. Okay, I have a comment by Isaac. He's saying he's not seeing the working. Can someone else confirm you can see my working? So I know if it's at my end or it's Isaac. Is that Isaac?
Yes,
End?
we can see.
Okay.
Maybe he's
Okay.
having
So
network issues. Let him log on.
okay. Okay. So Mr. Isaac, you might want to quickly maybe log out and log back in. It would be a little bit slower. Wait for you. In fact, we're doing scenario A and B, so you have option to consolidate with scenario B as well as scenario A. So let's get right into it. We discussed in NPV computation. I said that our presentation format, that the first item you're going to begin to look at, regardless of how intimidating the question is, don't let it intimidate you. Once you have your knowledge on the presentation format, you're not going to miss out anything. We said the first thing you bring into your computation is your sales. So if you miss that, please watch the video. It's our sales. So we need to know what is our sales for scenario A, because we're under scenario A. What is our sales for 2020, 2021, 2022, and 2023? So let's get right back into our question and see what we have as our sales. Okay. Under scenario A, we have our sales 100 million, but that sales for what year? Let's be very sure what year that is. So it says right here, that forecast operating cash flow for the year ending December 31st, 2020 is as follows. So what we have here is for the year ended December 31st, 2020, and our first year is 2020. So our sales for our first year, which is 2020, is 100 million. So that one is pretty straightforward. So that's pretty straightforward. Our first year, because those values were given to us at the end of this, after December 31st, 2020. So our sales for the first year is 100 million. But what of the subsequent years? Let's go right back on. What of after 2020? Because it doesn't tell us it's 100 million for all the years. It just tells us that it is that the figure is for 2020. Now, right here, it tells us what would happen in all of our subsequent years. It says all operating cash flow shown above, everything you have above, are expected to grow by 5% per annum in subsequent years for the duration of the project. So our sales is expected for every other year is expected to grow by 55% per year. So what would that be? 5% growth on that value per year. What would it be in the next year? So that would be 100 million multiplied by 1.05, adding 5% to the existing 100%. So what do we have as our sales for the next year? Just a minute. My calculator, please. Just hold on. Let me fetch that. If you have yours, please bring it out right away. Okay, so that is 100 million multiplied by 1.05. That gives us
105.
105. The next year, it said it's going to grow for 5% for every year. 105 multiplied by 1.05. 1 representing 100%, 0.05 representing 5% increase on what we currently have. So that gives us, multiplied by 1.05, that gives us, do we operate two decimal places? Maybe we should. That gives us 110.25. Then finally, 110.25. So it's a little bit, my hand, it's a little bit, the figures are a little bit thinner right now because I'm trying to fit them into that space. So I believe you can, if you have the notes, you can see it clearly, or you can just note it down in your own answer. So 110.25 multiplied by 1.05. I'm going to have a problem if my calculation extends to another year. I hope it doesn't. If it does, I need to come back and have that somewhere else. Okay, so it's not just legible enough. 110.25 multiplied by 1.05. So 110.25 multiplied by 1.05. Okay, so what does that give us quickly? That gives us 105.76. That gives us 115.76. Okay. That's our sales for scenario A. Let me see if there are any hands so that we can move on to our next part. Mohammed, please go ahead.
Thank you. Good afternoon, sir. Thank you very much. These are those figures in brackets. I don't know, maybe if you can take them up on top of the figure. Let's say the 105.
Okay, I get what you mean. Yeah, that works. If it's clearer. Yeah, I get that. It works. It worked perfectly fine. Thank you for that suggestion. It works. So it's just that you guys are going to make me do the calculation all over again. But let's see how it goes. Okay, so let me do 105 here. And then under it's where I put what the calculation is. That's what you mean, right? Mohammed, that's what you mean, right?
No. The 105 should be down, then the bracket should be at the top.
At the top. Okay. It also works for me. Okay, it also works for me. Okay, so you would have 105, then the bracket 100 multiplied by 1.05. Okay, yeah, it works for me. So 105 multiplied by 1.05 to show my computation. Then we can take this off. Then we have 110.25 multiplied by 1.05. Okay, so that makes a lot of sense, because it means that if I have a new year, I can just add it to the next without worrying about cleaning or extending anything. Okay, thanks, Mohammed. That's helpful in rearranging how we present it. Okay, thanks. Sophia, your hand is up quickly, so we can you go ahead with the comments or question so that we can move ahead?
Okay, sir, sorry, please. I just want to confirm. This figure now, I think it's in dollars, right? Because the Naira up, I'm just...
Oh, sorry. Okay, sorry. Why did I put Naira there? Yeah, so we have it. We're still in Linda, and we have the values as Lindarian dollar here. So I don't even need to write it again here. So I've already written that it's Lindarian dollar by this side. Okay. So, but just for clarity, we can just do that. I guess just for clarity, we can just do that. Yeah, so that's what happens when you love Nigeria so much. You write Naira everywhere. Okay. All right. So let's see if there's another question quickly. Adetunji, please go ahead quickly so that we can make progress. We need to move a little bit faster.
Okay. Good afternoon, sir.
Yeah, good afternoon.
Good afternoon. Actually, what Sophia was saying was my question on the graph and the chat box, that whether we are trying to convert first or you are trying to do the Linda first.
No. We're doing Linda first. We've explained it. We explained it now. That we'll start with the foreign country and then we'll repatriate to our home country. Okay.
All right.
So the transaction is happening in Linda. So I guess I was thinking Naira Nigeria. All right, so let's get right back to our question. So we have our sales.
Okay.
Now you also remember, you're welcome. You also recall that in our presentation format, when we did NPV, which is what you would typically use. You would please go back to that if you missed that class. We said that you would have your sales, you less your what? Variable cost. That would give you your contribution, and then you'd less your fixed cost to get your net cash flow before tax. That's what we explained. However, in this particular question, they did not break down the cost into variable cost and fixed cost. They just gave us cost. They didn't break it down. So we're not going to have that breakdown in our solution into less variable cost, less fixed cost. Rather, we're just going to have one line as less cost. If they had broken down the value into variable cost and fixed cost, we would have first subtracted our variable cost to get our contribution, and then we then subtract our fixed cost before we get our profit or what have you before tax. But we don't have that in this scenario. We don't have that in this scenario, so we have to skip that and group it together as a single cost item. So just take note of that while we're doing that. Okay, so let's go to our question and see what the cost is that we're given in the question. Don't forget, we are in Linda. So all of our computation would be in Lindarian dollar. When we're done with Linda, we can then convert the fund into Naira. So let's go right back to our question. Okay, so our question tells us that the values we're given is at the December 31st, 2020. And we're given cost for that year as 10 million Lindarian dollar and 20 million Naira. Guys, can we add these two values together directly? No, we can't. No, we can't. Because they are both in different currencies. So because we are dealing with Lindarian dollar, we need to convert the Naira to Lindarian dollar. So it's more like somebody telling you, see $100, see 1,000 Naira. You cannot say 1,100 because they're different currency. So you need to convert the dollar to Naira so that you know the total value in Naira, or you convert the Naira to dollar so you know the total value in dollar. Okay, guys, that's what you need to do. But in this case, because we are trying to determine the value in Lindarian dollar, we convert the Naira value to dollar. So that leaves us to our second concept, currency conversion. How do we convert from one currency? How do we convert from one currency to another currency? Okay. All right, so that leads us to that part of our question. So let's do that quickly. Let's discuss the concept of currency conversion quickly. We're going to do that in 5 minutes. So that's our second concept I want to consider, the concept of currency conversion. Okay, guys, pay attention as we do this. And this principle is very important that you must learn now, because you're going to see applied when we do advanced risk management, when we begin to do risk management, forward contract, future contract option. We're still going to do currency conversion at that point in time as well. But at that point, we might not spend this much time on the concept again because we already explained it so that we can make good use of our time. All right, so let's go ahead with the concept of currency conversion quickly. So how do you convert from one currency to another? Now, the first thing you should know is how currencies are quoted. Now, how currencies are presented, rather, not how currencies, how exchange rates are presented, rather. Now, exchange rates are often presented in the format variable against base. Variable against base. The variable is the number of units required to buy a single unit of the base. The number of units of value. Number of units of value required to buy or purchase a single base. And so because of that, the base is always equals to 1. The variable is the value that would always change, except in scenario where it is 1:1. So let's explain the concept very well. So if you go to an FX dealer in Nigeria now, and you tell the FX dealer, can you tell me what the exchange rate is, Naira against dollar? The FX dealer would tell you, for example, maybe you went there today. What's the exchange rate today? I don't follow Naira, the exchange rate these days. Okay, all right. So just for simplicity purpose, I'm just going to assume exchange rate. So the FX dealer might, please make use of the hand raise feature if you need to speak to me. I'll call on you when I need to call on you, please. Now, the FX dealer would, for example, tell you, just keep your hand up. I would call on you when I need to call on you, please. Just keep your hand up. All right. So the FX dealer might tell you, for example, that the exchange rate today, just to keep it simple, the FX dealer might tell you that the exchange rate today is 1,400 Naira to $1. You go back next time, the FX dealer might tell you that the exchange rate is maybe 1,385 to $1. Or maybe you're trying to exchange between the US dollar and euro. And you go to the exchange dealer, and the exchange dealer is telling you, oh, our exchange rate is, for example, this is euro, 0.90 euro to a pound or a dollar, okay, to a pound or a dollar, whatever we're converting to it, which is when we say A, we're talking about one. We're talking about one. We're talking about one. Now, in this scenario that I've explained, which is what we encounter whenever you want to exchange money, or if you log on to or you look up to any website where they present currency exchange. Now, with these values I've informed you, notice one thing. One value is always changing, and the other is always one. So an FX dealer will not tell you, my dollar today is 1.5 to $5. An FX dealer will not tell you that. An FX dealer will always tell you it is XXX value to 1, XXX value to 1, or YYY value to 1, or ZZZ value to 1. That's a very important concept. Because if you understand that concept, you then know how to convert. If you don't understand the concept, you don't know how to convert. So let's see if you understand the concept when I've explained. And maybe I would like to hear some voice. Some people speak to me. So in the first scenario, 1,400 to $1. Which of the currency between Naira and dollar is the variable and which is the base? We said the base will always be equals to 1. So guys, which of them is the variable and which of them is the base? Yusuf, please go ahead.
Thank you, sir. Naira is the variable and dollar is the base.
Thank you. Very important concept you must understand. And let's look at the last one. 0.90 to a pound or 0.90 to 1 pound. Which of these currencies is the variable and which of them is the base? Yes
is the
and no.
base. Okay, sorry.
Sorry, hold on, please. Hold on, please. I need to get someone else. Yes and no, please go ahead. Because I want to be sure that we all understand the concept. So I'm calling on no. Please go ahead.
The euro is variable while the pound is base.
Thank you very much. Now that is an important concept. Yeah, thank you very much. That is correct. Thank you, that's correct. That's correct. Now that's an important concept to know because that will determine how you treat or how you convert currency. So what is the rule on conversion? Now let's go to what the rule is on conversion. So this is the rule on conversion. Now that you know that every currency is variable against base, and you also know how to identify a variable and how to identify a base. So what is the rule? Now this is the rule on currency conversion. A, if you are converting the base, if you are converting the base currency, if you are converting the base currency, you multiply. D, if you are converting the variable currency. If you are converting the variable currency, you divide. It's as easy as that. The other concept we will discuss, which is the concept of direct and indirect quote, but that would only be applicable when we're doing advanced interest risk management. But for now, for currency conversion, this is just what you need to know. First thing you need to know is, whenever you see an exchange rate, ask yourself, which of them is the variable and which of them is the base? That's the first thing you need to know. The second thing you need to know is, when you determine which of them is the variable and which of them is the base, the next thing you need to determine is what are we converting? If we are converting the base, we multiply. If we are converting the variable, we divide. So let's do a quick example to be sure you understand the concept. Let's assume that you go to an FX dealer, and the FX dealer tells you that the exchange rate is, to keep it simple, 1,800 naira to no, we don't go for 1.8. So let me reduce that to 1,000. So 1,000 naira to $1. That's the exchange rate. Now you are trying to convert 1,000 dollar to naira. What will be the value in naira? B, you're trying to convert 500,000 to dollar. $500,000 to to naira. What is the value? Now let's apply our principles. Let's apply our principles. These are two different scenarios. They're not two different. If you go to an FX and tell you that 1,000 naira to $1. Scenario A, Mr. A is trying to convert $1,000 to naira. Scenario B, Mr. B is trying to convert 500,000 naira to dollar. So what are the values? Now let's begin with our explanation. Now, if you follow the steps, you would not mix it up. You will not miss it if you follow the steps. And these are the steps. What is the first step? What is the first step we say we'll do? What is our first step? Determine how the currency is quoted. So why is the currency quoted? It is 1,000 naira to $1. So guys, which of them is the variable and which of them is the base? We said the base is always 1. So who wants to give us a try? Who wants to, just to recap? I know we've explained it before, just to recap it. These values, which of them is, so Adetunji, please go ahead.
So good afternoon, sir. So that means the 1,000 is the variable, while the dollar is
just tell me the currency. Don't forget about the value. Just tell me the currency. I'm interested in the currency.
Okay,
that's what I'm interested in.
The naira is the variable, while the dollar is the base.
Thank you very much. That is the point. That is the key point I want you to know. Forget about the values attached to it. So the naira is the variable and the dollar is the base. Now you must get that right. If you don't get that right, you're going to mix up with the conversion. That's the first step. Never miss that step, especially when you're still learning the ropes. Now the next step would then be, what are we trying to convert? So let's look at what we're trying to convert. Scenario A, we're trying to convert $1,000. So we're trying to convert the currency dollar. So is dollar our variable or our base? Is dollar our variable or our base?
Our
the
base.
Dollar is the base. So when you are converting the base, what do we do? If you are converting the base, what do? We do what? We do what?
Multiply.
We multiply. So that would be 1,000 multiplied by the same 1,000. So what is the value in Naira? 1 million. Now let's look at the second scenario. 500,000 Naira to dollar. We're trying to convert Naira. Is Naira the variable or the base? Naira is the variable. And what is the rule? What is the rule? If you are converting the variable currency, what do we do? What do we do?
We divide.
Divide.
So that is 500,000 divided by 1,000. So what is the dollar value? $500. Guys, you must never get it wrong in currency conversion. It's as easy as that. Don't overthink it. It's as easy as that. Don't overthink it. It's as easy as that. Okay, so that's principle we should understand around currency conversion. Now, another principle that you need to understand, which we're going to just touch on the part that's applicable to this question, would be on, and we're going to do that when we get back, when we get to our question, is the principle of currency projection. Projecting or forecasting, possibly the most appropriate word would be forecasting. The principle of forecasting foreign exchange. Forecasting foreign exchange. So, and that is important because as a business, I'm mindful of my time on this project, and that's because as a business, when you go into a foreign investment, you're considering projecting your values or what you will make or your performance in future. So you're looking at, if I want to invest in, I'm considering moving into Linda, and I'll be there in Linda in 4 years. So I need to have like an estimate of what could possibly be the exchange rate at the end of year 1. What could possibly be the exchange rate at the end of year 2? What could possibly be the exchange rate at the end of year 3, year 4, year 5? So you need to be able to project. You need to be able to project. You need to be able to project or make that projection. Now, there are 2 broad methods of doing that. The first method is to use your purchasing power parity theory, which is called inflation. So when you use inflation, the method is called purchasing power parity theory. Purchasing power parity. Or to use interest rate. And once you use interest rate, it is called interest rate parity. And this is the format for doing that. So the format would be the exchange rate at the point in time. When I say T, I mean the point in time. So exchange rate for year 1, exchange rate for year 2, exchange rate for year 3. That's what I mean by the letter T. Is equals to the exchange rate at the beginning of the period, or the exchange rate at the end of the previous year, which refers to the same thing. So for example, if I'm trying to find out what the exchange rate is for 2025, I'm going to start by saying, okay, what is the exchange rate at the beginning of 2025? Or what is the exchange rate at the end of 2024, which is the same thing. So what is the exchange rate at the beginning of 2025? I'm trying to find the exchange rate for the end of 2025. What's the exchange rate at the beginning of 2025? Multiply that by 1 plus I. Now, I can be inflation if you are using inflation, and I can be interest rate if you are using interest rate. So the inflation rate of the variable currency divided by 1 plus I of the base. So what do we mean by variable? So for example, if you are doing Naira against the dollar, if the Naira is the variable, so it will be the inflation rate of Naira that will be up, and the inflation rate of dollar will be down. If you are doing pound against euro, whichever country's currency is variable, the inflation rate will be up, the other one will be down. And that's why it's very important to know variable, which currency is variable, which currency is base, because you would always make use of it. I don't know what this question is about. So when we get to it, we would know whether or not it's on that. But if not, I could recommend a question you could practice with use on this particular, so you can practice this without the formula, as easy as that. The second method is percentage change. The second method is percentage change approach. Depending on whether the currency is strengthening or weakening. So that's a percentage change approach, depending on whether the currency is strengthening or weakening. So let me ask you guys. So I tell people that if you have a passion, being a financial analyst or pursuing a career as a financial analyst, it's important that you listen to business news so that you familiarize yourself with some of these terms. And if you do listen to business news or you read business news, you would often be hearing the term, oh, the Naira is strengthened against the dollar at the FX market today, or it weakened against the dollar, or whatever it is, one strengthening, one weakening. So when we say a currency is strengthening against another currency, guys, what do you think it means? It basically means that you require less of your currency to buy the other currency. That is what it means. So that whenever you hear the term, oh, the Naira strengthened against the dollar, it means that you require less to buy the other currency. So what do we mean by that? When we say, I'm going to come back to that. When we say it is weakening, we're basically saying that you require more to buy or purchase or transact in the other currency, to purchase, buy, whatever term you want to use, the other currency. So if, for example, yesterday, the exchange rate was 1,485 to a dollar yesterday. And today, the exchange rate is 1,480. Quick question. Do we need more Naira or less Naira to buy dollar? We clearly need less Naira. We need less Naira because yesterday we needed 1,485 Naira to buy dollar. But today we need 1,480 Naira to buy dollar. So that's less. And if you need less to buy the other currency, we say what? The Naira is what? The Naira is what? It's strengthening against the dollar. Now, if yesterday it was 1,485 and today it is 1,490. So what do we say? The Naira is what? We need more Naira to buy dollar. So what do we say? The Naira is what? It's weakening. It's weakening against the dollar.
It's weakening.
Thank you. It's weakening against the dollar. Now that concept is very, very important, especially when you are dealing with the percentage approach. Because ICAN might tell you, oh, the Naira strengthened against the dollar by 10%. Or the Naira weakened against the dollar by 10%. What you do will depend on what direction it is going. So if it's weakening, you know that you need more. So you are adding. You need more, so you are adding. If it's strengthening, you know that you need less, so you are subtracting. It's reducing, so you are subtracting. Okay, so those are concepts on exchange rate. Now let's go back to our question and continue where we stop. And then we'll come back and explain another concept as we come along with it. We stop at the point where we had cost. And the reason why we had to come explain this is because our cost had both the Lindarian element as well as the Naira element. And we needed to convert the Naira element to Lindarian dollar. So let's go back to our question on our cost now. So these are the two methods. So I don't know which of them is in the question. I can remember that, but when we go back, we'll determine which of the two methods we are meant to adopt in our question. So whichever method we have, I would get a question that you guys can practice with using the other method. Then we can maybe have a quick up. Sorry, I should be going down, not up. Okay, so let's go right back to our cost. So our cost is 10 million Lindarian dollar and 20 million Naira. Don't forget this line. All operating cash flow shown above are expected to grow by 5% per annum in subsequent years for the duration of the project. So let's go and do our computation then. Because we have an extended computation, we'll do it in our notes. So we can call this working one. We can call this working one. So let's go right down and do our working one, which is our cost. Okay, so we have our Lindarian dollar. So we have 2020, 2021, 2022, 2023. We have the Lindarian dollar equivalent of our Naira, of the Naira element. We're going to come back to that one because we'll compute that one separately, but we need to convert that one. So when whatever we get, we sum it up to get our total cost. We sum it up to get our total cost. We sum it up to get our total cost. Okay, so let's begin with the Lindarian dollar part. That one is pretty straightforward. It is $10 for scenario A. And then it is growing, all of our cost is growing by 5%. So can we quickly get what that would be for all the other years? So that would be 10 multiplied by 1.05. What do we have, guys?
We have 10.5.
So that's 10.5. 10.5 multiplied by 1.05. What do we have, guys?
We have 11.025.
Okay, so we can just put it 11.03. So we just make sure that we don't have too many decimal points we're handling on that part. Okay.
So 11.576.
multiplied by 1.05.
11.57625.
Okay, so we can put it as 11.58. So that one is pretty straightforward. It's pretty straightforward. Let's come to the Naira, the Naira part, because we need to convert the Naira part to Lindarian dollars. But first, let's even determine what the Naira value is after we've added inflation to it first before we convert. So it is 20 Naira. So this is Naira, 20 million Naira. The next year, it is 20 multiplied by 1.05. What do we have?
We have 21.
Okay, so we have 21. The next year, it is 21 multiplied by 1.05, guys. What do we have?
22.05.
22.05. Following year, we have 22.05 multiplied by 1.05. What do we have?
23.1525.
Okay, so we can do 23.15. Okay, so let's convert. What is our exchange rate? Okay, so let's do our let's determine our exchange rate separately so that we can always come back to that much later on. So what is our exchange rate? So let's see what our exchange rate is. There are two methods for exchange rate. It's either they give us inflation and interest rate and we use that, or they tell us that the one currency, what currency does what? Strengthens or weakens against the other one. So let's go to our question. Let's go back to our question and see what we have on the exchange rate so that we can convert properly. Okay, so I think we have the exchange rate around here. So meaning that it's method 2 is applicable in this question. So I would encourage you guys to search for questions on method 1, or I can share a question on method 1 and we'll then look at just the calculation of the exchange rate only. And then I let you guys practice with the rest. Just the exchange rate only using method what? If there's method 1 that is in the question requirement, approach 1 rather, not method 1. Approach 1 that is in the question, and then I'll let you guys practice that. So let's look at what the question says with regards to our exchange rate. Okay, so we're just where it says, and it reads, the exchange rate is expected to be 1 naira is equals to 1.200 Lindarian dollar. Quick pause. Which is the variable and which is the base? Guys, we don't have to miss that. Which is the variable and which is the base? Who wants to give us a try? Just make use of the hand raise feature so I could call on you. Tunji, I would like to hear someone else's voice, but let me hear someone else's voice. Tunji, so hold on, let me hear someone's voice. If anyone, please go ahead.
Okay, sir. Good afternoon.
Yeah, good afternoon.
Hello, good afternoon, sir. So the variable is a Liberian dollar 1.2 and the base is naira 1 naira.
Thank you. Very easy. The base is always what? The base is always 1. The base is always 1. So you mustn't forget that. So that will determine what we do next. The base is always 1. So that will determine what we do next. Now let's go on to our question. It says, and the naira is expected to strengthen against the Lindarian dollar by 2% a year in each of the next 4 years. So on January 1, it is 1:2. Then for each of the next 4 years, so that means end of 2020, end of 2021, end of 2022, end of 2023, which are the next 4 years. So if for each of those next 4 years, the naira is expected to strengthen against the Lindarian dollar by 2%. So when we say naira is strengthening against the Lindarian dollar, what do we mean? We'll explain the concept. I need to get some feedback so I know you guys understand what I'm saying, because we're not going to come back here again. So when I say naira is strengthening against the Lindarian, one currency is strengthening against another currency, what do we mean? I can go back to the slide if you want to read it out to me, but I need someone to be able to confirm that you understand the principles I taught right there. Okay, so I'm coming right here. Yeah. So I'm on that page. Okay, so Ismaila Abubakar, please go ahead.
afternoon, sir. Well done, sir. So Naira is strengthening against the dollar.
Yeah, so what does it mean? Do I need more Naira or I need less Naira?
No, we have less Naira, sir.
We need less Naira. That's the point I'm trying to arrive. You need less Naira. Thank you. That's the point. Because the Naira is strengthening, you need less Naira. Now, there's an important principle to note here, which I should state before I proceed, that the way it works is if one currency is strengthening against the other currency, automatically the other currency is weakening against it. So what do I mean by that? If Naira or Euro or Pound, whatever the currency is strengthening against the dollar, it automatically means that dollar is weakening against the Naira. And if Naira is weakening against the dollar, it automatically means that dollar is strengthening against the Naira. So if this one is weakening, automatically the other one is strengthening. If the other one is strengthening, automatically the other one is weakening. So how do we do our computation with percentage change? Now, if it is strengthening, because you need less, our approach will just be 1 minus the rate. We then multiply it by the exchange rate at the beginning of the period. 1 minus the percentage rate at which it is strengthening. And if it is weakening, where's my pen? If it is weakening, the formula is 1 plus the rate by which it is strengthening multiplied by the exchange rate at the beginning of the period. So if it is strengthening, 1 minus because you need less. So it's minus, you need less. So subtract it because you need less. If it is weakening, you need more. So you're adding because you need more. So let's go right back to our question. And so that with that approach, it's very easy for us to know what to do. So let's go right back to our question now. Let's go back to our question. So we are given exchange rate of 1 Naira is equals to 1.2 Nigerian dollar. So I know I see your hand up. I'm going to come to your hand. Let me just solve this. It might help answer your question. And if it doesn't answer your question, I'll then take it.
All right, sir.
Yeah. So we have our exchange rate on January 1, which is at the beginning of the year, 1.20. The question says that Naira is strengthening against the Nigerian dollar by 2% per year. The question says that Naira is strengthening by 2% per year. Now, what is this? And so if Naira is strengthening, automatically, what is happening to the Nigerian dollar? Automatically, what's happening to the Nigerian dollar? From what I explained, if Naira is strengthening, automatically, what's happening to the Nigerian dollar?
To weaken.
10 minutes, please go ahead. It's what?
It's weakening.
It's weakening. It's weakening. Thank you. So, and we say that the formula for when it's strengthening is 1 minus R. The formula for when it's weakening is what? 1 plus what? R. So let's go back to the value we're given. We're given 1.20 Lindarian dollar. We're not given 1.20 naira. If we're given 1.20 naira, we would just because the naira is strengthening, we would do 1 minus R. But we're given Lindarian dollar. We're given 1.2 Lindarian dollar. So what is happening to Lindarian dollar? Is it strengthening or weakening? The question says naira is strengthening, but what is happening to Lindarian dollar? Is it strengthening or weakening? What's happening to Lindarian dollar if naira is strengthening? What's happening to Lindarian dollar is what? It is what?
Weakening.
It's weakening.
So, yeah, so because it is weakening, we're going to use 1 plus R because we are given Lindarian dollar. If we are given naira, maybe 5 naira or 1.2 naira, and we're given naira, and naira is strengthening, and naira is the currency that as the variable, we would use 1 minus R. But because we're given Lindarian dollar as 1.2 Lindarian dollar, and Lindarian dollar is weakening, we would use 1 plus R. So what is the percentage rate at which it is weakening? 2%. So that would be 1 plus 2% is 2 divided by 100 is 0.02. Multiply that by 1.2. So what is the value at the end of 2020? And then I'll take questions if there are any after we're done with that quickly. So I need to move progress. I need to make some quick progress. Okay.
1.224.
Okay, sorry, let me get my calculator as well. 1.2 multiplied by 1.02, 1.02, 1.224, 1.224 multiplied by 1.02 for the next year. What do we have? 1.224 multiplied by 1.02 for the next year, because it's the same thing for every year, gives us 1.24885. Let's just do 4 decimal places. I like using 4 decimal places for exchange rate. And then the next one.
Okay.
Next, sorry, 1.224 multiplied by 1.02, yeah, 1.2485, and then the next one, 1.2485 multiplied by 1.02, 1.2734,
yeah,
1.2734. Then finally, that multiplied by 1.02, I have 1.2989. 1.2989. So that is 1.2734 multiplied by 1.02. Okay. So those are our exchange rate, guys. And now your hand was up. Please, can you go ahead now if your question hasn't been answered?
Hello, sir. Hello, sir.
Yeah, I can hear you, please.
Hello.
Yes, I can hear you. I can hear you. Please go ahead.
Good afternoon.
Yeah, good afternoon.
Yes, I want to the calculation where you have when we have the weakening and the strengthening aspect of it. If naira is strengthening, and when the other dollar is weakening. I was able to get it, but I'm confused at this last calculation where we calculate to get 1.22. I think we're supposed to have 1.224 times 1.2 as we have in 2020.
2%. No, 2%. No. 1.2 is 20%. 2% is 0.02. So that's 1.02. 1.2 is 20%. So it's just 2 divided by 100, then plus 1. It's 1.02.
Okay.
Yeah,
Okay.
so yeah, 1.2 is 20%. Is that okay? Yeah.
I'm not getting where you get the 20%. I have I saw where you get the 2%.
Which 20% are you referring to? I always said you mentioned 1.2 and I said 1.2 is 20%. Are you referring to this 1.2 here? So are you referring to this 1.2 here?
Yes.
Okay, yeah. Okay, yeah. So that's the exchange rate at the beginning of the year. We're now using it to project or estimate what the future will be.
I understand, sir.
Okay, okay.
I got it, sir.
All right.
Thank you.
You're welcome. Yes. You're welcome. Okay, Yusuf, your hand is up quickly, so that we can move on.
Yeah.
Spend
Sorry,
so much time on
my
this.
own question is regarding.
Sorry. Why I put on? I'm sorry, Mr. Isaac. Can you please help us turn off your video so that you can save on our bandwidth for those that have low internet or something? Thank you. Yusuf, please go ahead.
Yeah, we are going to start the 2% increase in year 2020. Initially, I thought the year 2020 will be our base year, so that we will start in the year 2021, the 2% strengthening.
Okay. Okay, good question. No, we're not going to start. And that's because you need to read the question and understand very well to get the gist of the question. So look, let's go back and read that quick way. Where's my question? Okay, it's up. Okay, so let's read the question very well again. The exchange rate is expected to be $1 is equals to 1.20 on January 1st, 2020. At the beginning of the year. Don't forget, we discussed timing of cash flow when we did NPV, and we said whatever happens at the beginning of the year is generally assumed to have happened the previous year in terms of placement. But even without that, it happens January 1, 2020. And Naira is expected to strengthen against the Nigerian dollar by 2% a year in each of the next 4 years. Our project is for 4 years. So which years are the next 4 years? Which years are the next 4 years? Based on our project, for 4 years. So which years are the 4 years?
Yeah, I got
2020,
it. 2021, 22, and 23.
So
that is
yeah,
true.
so sometimes
Thank you, sir.
you need to pause. Yeah, you need to pause and read the question to understand it before you proceed. That's very important. Okay. So now that we have done our exchange rate, let's what do you call it? Let's convert. Let's what do you call it? Let's convert. So we said that based on the exchange rate, the variable is what? Nigerian dollar. The base is Naira. What are we converting? We're converting what? What are we converting? Are we converting the variable or the base? These values, what are they? These values are they? Sorry, not this value. This Naira, the Naira element, what are they? Are they variable or base? What are they? That's what we are converting. What are they? Are they Naira? Is it variable or base? We are converting the what?
Base.
We are converting
The base.
Because we are converting Naira, we are converting the base. So when you are converting the base, what do we do?
Multiply.
Let's remind ourselves. Once you know the rule, you can never get it wrong. Once you know the principles and the rule, no matter how I can twist it, you will never get it wrong. The problem is when students memorize, they don't know why or what we are doing and the approach or the rule on it. So what do we do when we're converting the base? We do what? Just want to remind in case somebody just joined. When we are converting the base, you do what? You multiply. So that's what we're going to do to convert Naira to Nigerian dollar. That is what we are going to do. We're going to multiply. It's as easy as that. It's as easy as that. Once you know the rules, the reason why, regardless of how the exchange is twist, how the currency format is adjusted, you know what to do. You know what to do. So let's do that quickly so that we can make some progress on that. At the minimum, it would be nice to finish scenario A today. Okay. So let's do that quickly. So 2020, our exchange rate is 1.224. So someone can be helping me to do that. What's the value? Just bring it here. I don't need to write. So what's the value there? 2021, our exchange rate is 1.2485. 2022, our exchange rate is 1.2734. 2023, our exchange rate is 1.2989. So guys, what's the value for the first one? Let's make a calculator.
The first one is
24.248.
Okay, so our first one is 24.48. So 10 plus 24.48 gives me 34.48. Okay, what's our next one? Sorry, I need to.
We have 26.2185.
26.218. So that would be 22. So what's addition of the 2 gives us 36.72. What's the next one? Um, 22.05 multiply. What's the next one? What's the next one, guys? Where's my calculator? Sorry.
28.707847.
078.
So that would be 20 what?
28.078.
So that would be 28.08 because we're rounding up. We're rounding up the last one to the next value. So that would be 39.2. Yeah, 39 point. No, let me get that again. Let me quickly add that up again quickly. Sorry, guys. Sorry. So that's 11.03 plus 28.08. So 29.11 rather. So 29.11. Okay, next one.
You have 30.060.
11.58. I'm sorry, 11.58. 23.15 multiplied by 1.29 multiplied by 1.2989 gives us 30.07. 30.07. 069. So we round up the round to 7 to push it forward. So that gives us 41.6.
1.65.
Okay, so let's copy the values up. Spent quite some time on this really, but it was important I explain those concepts for it to you guys. Very important. So I need to copy the values that we have up. So I have 24.48. We have 24.48 as my cost. I have 36 points. What again?
Is 34.48.
Yeah, 34.48. Okay, 34.48. 34.48. Okay. So where did I copy 20? Where did I get 24 from? Okay.
The equivalent.
Okay, that was also the one I used. Okay, that was the one I looked at then. So 34.48 is our total. The next is 36.72. The next is 39.11, if I remember that correctly. And the next is 41 point something. My brain has gone up on that.
85.
65. 41.65. 41 point. Okay, so those are our total cost. Now, before you round up or you subtract, it's always good to go to the question and scan through the question just in case there's a separate cost item that ICAN did not include under that cost. Sometimes they might have somewhere another cost item apart from this one that is not added on. So you don't keep solving and then you come back and say, there's maybe rent somewhere or there's another cost somewhere. So we need to quickly just scan through our question and see if we have any cost item anywhere else that might be important or necessary for our computation. So let's do a quick scan of our question. Very quick scan of our question. Okay, sorry, let me check the chat if there are any comments or question. Okay. Okay, so let's get right into scanning our question quickly to see if there are any costs somewhere that I can't even include in that cost that maybe we must have missed. We can just bring that in quickly before we move on. Okay, so this part of our question is on just an introduction part. The financial data here, let's see if there's anything here that's important to us. It says to date, 5 million has been spent. So that has already been spent. We explained it when we did NPV. So that's the sunk cost, it's not relevant. It has already been spent. So that's not relevant. It says if the project is approved, meaning that this has not been spent yet. If the project is approved, it's the future cost, it has not been spent yet. So if it's approved, an additional 20 million will be required for detailed market research and packaging design. The cost of the launch itself includes an expensive radio and television advertising campaign in Linda, and it is expected, so it has not been spent, it is expected, it's a future cost, it is expected, so it's a future cost. It costs 10 million, so we have 20 million for market research. We have another 10 million. Let's go ahead. Both of these costs are tax deductible in Nigeria. In addition, 84 million will be spent on a distribution center in Linda. All these costs, all these one-off costs are payable on January 1, 2020. So we have those what do you call it? We have those additional costs. We have those additional costs for us that are tax deductible in Nigeria. So they are not tax deductible in Linda, they're tax deductible in Nigeria. However, these are costs that Linda has that will be incurred for advertising, that will be incurred for that will be incurred for radio, but they're tax deductible in Nigeria. So we're going to leave that, since we're separating the performance into two, we're going to leave that until we get to Nigeria. When we get to Nigeria, we bring that, we account for that. For now, we just leave that as it is. We leave that as it is until we get to Nigeria, because they're tax deductible in Nigeria. So that means that will be the only cost that we have right now for our Linda market. I don't think there's any other thing. So when we get to Nigeria, guys, remember we need to come back and get those costs, because those are tax deductible in Nigeria. And that's because we're splitting. So there's no other thing. I don't think there's anything on cost anywhere. There's nothing else. Yeah, there's nothing else on cost anywhere. All right, so let's get our cash flow before tax. So our profit. All right, so 100 million minus 34.48. What do we have? 65.52 by my calculator. 105 minus 36.72 by my calculator. Someone could also confirm for me. We have 68.29.
It's correct, sir.
The next one. Yeah. The next one. 110.2. 39.25 minus 39.11.
That's 71.14.
28. Okay, yeah, so 79.28. Very true. I just reconfirmed that. Sorry.
I saw him down now.
Mute yourself. Please mute yourself if you are not speaking with us, please. So 0.28, please. All right. The next one, 110.25 minus 39.11. 71.14. 71.14. Finally, 115.76 minus 41.65.
Thank you.
What is this now?
0.11. Please, I need to just a moment. I need to mute. If you're not speaking with us, please mute yourself. Okay. So those are our values. Sophia, your hand is up. You can quickly go before we proceed. Sophia, are you there? Are you there, Sophia? I need us to finish scenario A quickly. Okay, we'll come back to Sophia much later on. Okay, so if we have taxation, our taxation will go in here. So let's see if we have taxation because it's profit before tax. So let's see if we have taxation. If we have taxation in Linda, our tax will go in there. So it says right here that corporate income tax is charged in Nigeria at 35% on taxable profit and is paid at the end of each of the year in which the taxable profit arises. So that's the tax in Nigeria, but we're in Linda now. No separate tax is charged in Linda. No separate tax is charged in Linda. So if there was tax, you put it there. So I'm just putting that line as a placeholder. So in case there's a tax in Linda, they're going to copy the tax and put it there. So no separate tax is charged in Linda. So taxation is 0 for us. So taxation quickly is nil, 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 and nil. It's 0 for us. Okay, so we're done with the profit statement part. Now let's move on to the investment part. We explained that with our format on NPV. It's still the same format. So let's move on with our investment. So how much are we going to invest in fixed asset to set up the factory or the distribution center in Linda? And at the end of the 4 years, if we do decide to do what, to close up, how much are we going to get from it? So let's see our question and say how much are we investing and how much are we getting back at the end of the 4 years in terms of the scrap value or the residual value. I think it's right in this paragraph, the first paragraph we read. So we're not reading the question all over again. It says right here on fixed cost, research side here, 84 million Nigerian dollar will be spent on a distribution center in London. So that's what we're going to spend to construct or buy the distribution center. So this is our fixed asset. So we're going to incur 84 million to buy Nigerian dollar. So when are we going to pay this amount? It says the cost is payable on January 1, 2020. Guys, we explained this concept when we did NPV. We said that any cash flow that occurs at the beginning of the year is assumed to have occurred when? It's assumed to have occurred at the end of the previous year. And that is because generally your December 31st value should be your January 1st value. So to enable us account for a full year, because anything that happens on January 1st is like it's like a full year transaction. So January 1st to December, it's going to stay in our book for a full year. So to enable us account to that, we always would, whenever we have a cash flow that occurs at the beginning of the year, would always assume that the cash occurred the previous year. We would always assume it occurred the previous year. So that being the case, what is the value? What year would our investment happen? It happened on January 1st. We assume that this is the previous year's transaction, and that would have been assumed to have occurred in 2019. So that means that we're going to add one extra year, which is year 0, our year 0. So we're going to add one extra year, which is our year 0, because it occurred at the start of the year. We assume that it occurred on the previous year. So that is 84. It's an investment. So the, the flow is going out of our hands. Now, at the end of the 4 years, do we expect to sell anything? Do we expect to dispose of this asset for any value? Do we expect to get anything out of it? If we don't have any scrap value, we move on. But if we have a scrap value or a disposal value at the end of the 4 years, we bring that in. So do we have that? Yes, we do. It says right here in point 2, a proposed new distribution center to be built in Linda is expected to have a residual value of 52 million after 4 years. So at the end of our 4th year, we've done with the project, we've closed out. We're going to sell the distribution center for an inflow, a positive value of 52 Linderian dollar. There is nothing on working capital in the question, so we skip that because there's nothing on working capital. So we're done. Let's calculate what our net cash flow is in Linda. What is our net cash flow in Linda? So this would be 84 Linderian dollar. There's no tax, but I'm putting that placeholder so that just in case there is tax, you can just compute your tax and subtract it, but there's no tax. So what we have up is what we are bringing down, except for the last one where we have inflow from the sale of our distribution center. Okay, and then finally 74.11 plus 52, you have 126.11. All right, any question on our transaction in Linda? So that's everything in Linda. There's no other part of the question that talks about any expense, any income, any cost in Linda. Sophia, please go ahead.
Please, I'm drawing back. I don't know how to get this total cost. I'm just struggling to get it.
Were you there? Were you around when we computed it? Because I don't want to take everyone back. Were you around when we computed it? I don't want to take everyone back because we spend a lot of time on that. But let me quickly go back where the total cost is. This is total cost. This is total cost.
Yes.
10 million.
As the total cost.
Look at it. Listen, please pay attention as I explain it. This is total cost. 10 million naira plus, sorry, not 10 million naira. 10 million Linderian dollar plus 20 million naira. 10 million Linderian dollar plus 20 million naira. We cannot add naira and dollar directly. We cannot. You cannot say 100 naira plus $100 equals to 200. No, you have to convert one to the other so that they are both on the same currency. So because we are computing the value in Linderian dollar, we need to convert the naira value to Linderian dollar.
Yeah,
okay.
I understand.
So what's the question?
I understand.
Yeah. So what's the question then?
Yeah, yeah. I'm okay. Yes, I'm okay. Thank you.
All right. So that's why we got those values. So the computation is down. All right. So we've determined our values in Linda up to this point. Any question on that? Because now we want to move these values from Linda to Nigeria. Any question? Okay. So the quick question you need to ask yourself at this point before you move the fund would be, do we have any restriction on movement of fund? So if, for example, the Nigerian government is saying you can only move 50%, it means that we can only convert or move 50% to Nigeria. If the Nigerian government is saying you can only move after 1 year, it means that what we make in year 1, we will move it in year 2. What we make in year 2, we will move it in year 3. But if there is no restriction, you can repatriate everything. So I want to tell to you guys that in terms of repatriation, please pay attention to if there is any in the question and compute accordingly. So pay attention to if these exist and compute accordingly. Very important. In our question, there's no restriction. It doesn't mention anywhere that there's any restriction in movement of fund. But if, for example, the question has told us that the Nigerian government restricts movement of fund to say 50%, what it basically means is that what we can only move to Nigeria would be 50% of the value that we make in Linda. So that would be 50% of 84. I'm sorry, that's negative. That's 84 is the spending, so that should be in bracket. That's negative. 50% of this, 50% of this, 50% of this, and 50% of that. If there is that sort of restriction, but we don't have that. So let's go ahead and convert. So what is our exchange rate again? Let's quickly get our exchange rate quickly, because we're moving all of these values back home to our home country. Okay, we're moving all of the values back home to our home country. So what's our exchange rate again? So I'm just going to copy the exchange rate we computed here, or maybe someone can call them out for me. So under year 0, which is the beginning of the year, or year 2019, it's 1.2, 1.224, 1.2485, 1.2734, 1.2989. So we're moving all of those. I'm trying to copy that into here. So at the beginning of the year, it is 1.20. The next year, it is 1.224. Don't forget our exchange rate is Nigerian dollar. The next year, it is 1.24 what?
2485. 1.2485. 85.
Thank you. And the year after that is 1.2 what? 27 something.
2734.
34. Yeah, and the last year, I know it's 1.29 something. Is it 89? Yeah, I think it's 89.
2989.
Yeah, 2989. Okay. So let's convert that, or let's remit it now home to Naira.
Who is there? Come now.
Now, this is what we're going to do when you are remitting. We're not going to mix them up. We're going to do two conversion. We were not going to mix up our profit part, which is this part, because our profit will be charged subject to tax. We're subject to tax in Nigeria, but we're not going to charge tax on investments. We're not going to mix this part with this part. So we're going to convert them separately. We're going to first convert the profit part so that we can charge tax on that part, because there's tax in Nigeria of 35%, and then we move the investment separately. That's what we're going to do. So we're going to move this part, which is the profit and loss part. Then we're going to move the investment part separately. So let's begin. Let's begin by moving the profit part, which is the up part. So our Naira value. So let's begin by moving the remitted profit first. So I'm moving the remitted profit first. So our years are 2019, which is year 0, 2020, 2021, 2022, and then 2023. Okay, so let's remit our profit now, right now. Let's remit our profit. Under year 0, there's nothing there. Now, under year 1, we don't have any investment. So our total here is our profit. Our total is our profit. But in year 4, we're going to skip and do just 74.11. So let's remit year 1. Now, how do we convert? Do we multiply or do we divide? Very easy. The rule is simple. We've explained the rule at the start of the class. If you follow the rule, you would not get it wrong. What is our variable currency again? What is our variable currency? What's the reminder? What is our variable currency again? Linderian dollar.
Linderia.
Right?
Dollar.
What is our base? Again,
Naira.
our base is Naira. We are converting Linderian dollar. All of these values you have, they are in Linderian dollar. So we are converting the variable. We have all the values we have above, they're in Linderian dollar. So we are converting the variable. When you are converting the variable, what is the rule? When you are converting the variable, what is the rule? We divide. It's as easy as that. It's as easy as that. We divide. So 65.52 divided by 1.224. What is the value? It's as easy as that. You must not fail currency conversion for any reason whatsoever. It's as easy as that. So 65.52 divided by 1.224, guys, what do you have?
53.53.
53.53. The next one.
68 divided by 1.2485. You have 54.69.
54.69. Next one. What's that? Let's confirm that.
You have 55.87.
55 point what? 87. Thank you. Then finally, what do we have? 55.87.
55.87.
Okay, so we have 55.87. And then the next one, what do we have?
We have 57.06.
57.06. 57.06. We have an expense. Yeah, we have an expense that is said is tax deductible in Nigeria. Don't forget that. We read it before, but we read that expense before, but we said that we're going to keep it on hold until when we get to Nigeria. Can you remember the expense? It was right in the paragraph.
Yeah. 10 million and 20.
So we have 20 and 10, both in Naira, giving us a total of what?
30 million.
Giving us a total of 30 million. And that is in 2020, which is ours. At the end of 2020 is when we're going to charge it to tax. Even though it occurred at the beginning of the year, but yeah, at the end of 2020 is when we're going to charge that transaction to tax. So we have our additional expense deductible in Nigeria. $30. Okay. So what do we have as our profit before tax in Nigeria? Okay, so this is 23.53. All other ones remain the same. 54.69, 55.87, and 57.06. Because that particular expense is tax deductible in Nigeria. Olatunji, your hand is up. Please go ahead if you have a question.
Okay, good afternoon, sir. Thank you so much. It's glad and so impactful. Okay, my first question is on the tax. Now, imagine we have that tax also in Liberia.
Yeah, I'm going to come to that. I'm going to come to that. I'm not discussed tax yet. So I'm actually open to question up to this point. I've not got to tax yet. So let me discuss tax first.
Okay.
And then if you have any question, you can then ask about that. Yeah, you're faster than me. If you have any question, you can then ask after that.
I have a second question, sir. My second question is on the foreign exchange. On the foreign exchange. Okay. An issue of weakening and straightening. Okay, can the question be silent whether to be weakening or straightening? And maybe they are expecting us to know the exchange rates. We are giving 1 naira to 1.2. In that case, we know that we have more naira, we have less naira to get more naira. Mean that we can actually deduce from that. Nigeria is actually straightening. So, in the any question, can it be silent in that manner that we want to determine whether to know whether it's actually straightening or weakening? Thank you.
No, sir. If it's a percentage method, it needs to tell you, because you need to know what direction the currency is moving. If it doesn't tell you what direction the currency is moving, how do you determine what direction, what the exchange rate is? So if it's percentage, it has to tell you what direction the currency is moving. If it is the first method that has inflation, interest rate, it won't tell you, because if that one has the formula, and I explain the formula there, it won't tell you that. But if it's percentage method, it must tell you. So because without it, you won't know what direction the currency is moving, right? Right? You won't know what direction. So you need that information to know what direction the currency is moving. All right. Okay. So let's move on to taxation. Now I'm going to explain the principles on taxation. So we spent quite some time on this up to this point because we needed to explain the principles a lot. So in the next class, we're going to be much faster because we would have explained all of the principles. So we'll just be solving it. We're not going to waste time explaining it. So let's take the next 2-3 minutes quickly to explain the principles on taxation.
Sorry, sir.
Okay. Is that someone's hand up? I didn't see any hand up. Okay, let me see if that hand is up. Okay, Mohammed, hand is up. Quickly. I need to explain that before we leave so that it's easier for me to just solve it. The other ones next class very fast. Go ahead, Mohammed. Go ahead.
I wanted to make a correction calculation for 2023.
Sorry,
the figure. I wanted to make a correction. 2023.
Oh, I can't hear you. Which of the figures, please? I got the figures from you guys. Which of the figures, please?
The figure for 2023.
2023. Okay, let me quickly confirm that.
Supposed to
quickly
be
confirm.
0.09, not 57.
Okay, it's meant to be what?
Supposed to be 09, 57.06.
Okay, so let just a moment. I think I got that from you guys, but let me quickly confirm that with my calculator. So that is 74.11 because we're remitting the profit. We're not on the investment part yet. We're remitting the profit first, divided by 1.2989. Yeah, it's 57.06. Can you confirm that? We're not remitting. We're splitting it into two. We're remitting the profit first because we need to calculate tax on the profit. Then we're not bringing the investment part after that. So it's 57.06, please. It's correct.
Okay.
Please reconfirm that. Okay, it's correct. Okay. So let's discuss tax quickly, and then we can call it a day. The next session will be a little bit faster because we would have explained all of the principles. So let me explain tax, and then I will take any final questions, and then we can close for the day. Okay, so let's go back to that part. So once we're done with that, I think let's see what principle we've explained and what we've not explained. I think would have explained all the principles with tax. Let me see if there's anyone. So that in the next session, we are doing scenario B. We're not explaining anything. We're just solving. We're not explaining anything. So what are the things we wanted to do? Yeah, so we've explained. We've explained currency conversion. We've not explained tax. We've explained repatriation. Okay, we've not explained transfer pricing, and okay, we'll explain those other ones next week then. Okay, so let's look at tax now. All right, so let's look at tax now. Let's look at tax, and then we're gonna call it a day for today. Okay. Now there are two things when it comes to tax. One, because countries would have different tax rates. So if you go to Linda, you go to, okay, fortunately for us, there's no tax in this our investment. But assuming you're investing in the US, you're going to have a US tax and US tax rate. And you also have Nigeria tax and Nigerian tax rate. So in that scenario, whenever you're treating tax, there are two things you need to consider. A scenario where there is no bilateral or double taxation agreement between the two countries. / double taxation agreement between the two countries. And then you're going to have a scenario where there is a bilateral tax between both. And then you're going to have a scenario where the question is silent. So the question doesn't tell you whether there is a bilateral or not. So in that scenario, I usually would recommend students to assume that there is none, and then state it clearly in your answer that you're assuming that there is no bilateral trade agreement because it wasn't mentioned. So I always advise students to assume that there is none. Since the question is actually silent on it, I was advise students to assume there is none. Some people might tell you, just assume any of them, but generally I tell people, be silent, assume that there is none. Now, if there is no bilateral taxation agreement, you would charge tax in both countries. So you charge the tax rate in both countries. So what do I mean by that? If, for example, in Lindarian dollar, the tax is 30%, so you charge 30% of that profit in Linda, put it under where we have tax. Then when you move to Nigeria, you charge another 30%. So if there is tax, our question said there's no tax in Linda. So if there was tax in Linda, you charge 30%, 20%, whatever the tax rate is in Linda on the profit you make in Linda. Then when you move it to Nigeria, you charge the tax on the profit in Nigeria. So that it doesn't confuse those guys. So let's assume that the tax in Linda is 20%, and in Nigeria is 30%. So you charge 20% tax on what you make in Linda, 20%, and then you charge 30% on what you make in Nigeria. So that's technically you are on your income, you are charging approximately 50% on your total earning. Approximately, we go as tax. We go as tax. However, if there's a bilateral tax agreement between both, which is the reason why most countries would like to go into double taxation agreement. If you listen to or you read publications by Nigerian Revenue Service, NRS now, you will always see a scenario where they have double taxation and all of that. So if that happens, you're going to charge the higher of the two tax. Total tax will be equals to the higher of the two tax. Total tax is equals to higher of the two countries' tax starting from the subsidiary. Starting from the subsidiary. So the tax is first going to come from the subsidiary, and then you're going to balance up with the home country. So let me explain this. Let me explain this quickly. So if there's a bilateral trade agreement, you're going to charge the higher of the two tax. So let's look at three possible scenarios. So this is scenario 1, this is scenario 2, and this is scenario 3. So let's assume we're using Linda and Naira. Let's assume that the tax rate is 20% in Linda and it's 30% in Nigeria. What are we going to do? Let's assume it is 30%, 30%. What will we do? And let's assume it is 30% and it is 20%. So these are all the possible scenarios. So regardless of how the question put it, you can attempt it. So what are we going to do? In scenario 1, what is the tax we will charge in Linda? What is the charge we will charge in Naira? So we're going to charge our tax in Linda first. We're going to charge our tax in Linda 20%. We said that because there is a bilateral trade agreement, your total tax will be the higher of the two. And the higher of 20 and 30 is 30. And you have already paid 30. So you need a balance of 10 to take you to the higher of 30. So you're going to charge only 10% tax on the profit in Nigeria. If it is 30-30, you're going to start with Linda, which is where you're doing your investment. So you're going to charge 30% in Linda. The higher of the two, the higher of 30 is 30%. You already paid 30 already, so there's no tax here because you already paid the higher of the two. Scenario 3, 30-20 is 30. 30-20 is 30. So you're going to charge 30% here. You've already charged the higher of the two, which is already 30%. You're not going to charge any tax here. So that is how we would treat tax in international taxation. Any question, guys? We'll move past our time, and I need us to have done 10 minutes past our time because we started 10 minutes late. Any question on our treatment of taxation? Very important that we understand this principle because I won't solve questions that have all of them. But once you know the rule, you know what to do.